scholar at the American Enterprise Institute, who has previously held a variety of positions with the FDIC, other public sector, and private sector institutions. Without objection, each of your written statements will be made a part of the record after your oral remarks. For those who have not testified there, and I'm somewhat uncertain whether Chairman Frank has ever testified from the table, but I know he knows the system, the green, yellow, red lighting system. Green means go, yellow means wrap it up, red means stop. We have not improved the audio system since Chairman Frank's day, so you will need to take the microphone and bring it very, very close to your mouth so that all can hear you. Mr. Wilson, you are now recognized for a summary of your testimony.
Thank you, Chairman Hensling. Ranking Member Waters.
Regrettably, that is not close enough. Pull it a little closer, please.
My name is Dale Wilson. I'm the CEO of First State Bank of San Diego, a rural community bank serving a small South Texas town. I appreciate the opportunity to be here to present the views of the Texas Bankers Association on the impact of Dodd-Frank Act. Let me start by thanking my own Congressman, Ruben Hinojosa, who serves on this committee. We had a pleasure of hosting Congressman Hinojosa at my bank in South Texas, and we appreciate his service to our community. During the last decade, the regulatory burden for community banks has multiplied tenfold. Dodd-Frank alone has already added nearly 14,000 pages of proposed and final regulations. Managing this tsunami of regulation is a significant challenge for a bank of any size, but for a small bank with only 17 employees, it's overwhelming. Today, it is not unusual to hear from bankers ready to sell to larger banks because of the regulatory burden has become too much to manage. Since the passage of Dodd-Frank, there are 80 fewer Texas banks. These banks did not fail. Texas has one of the healthiest economies in the country. We call it the Texas Miracle. These were community bankers, and I've talked to some of them personally, that could not maintain profitability with regulatory cost increasing between 50 and 200%. These are good banks that for decades have been contributing to the economic growth and vitality of their towns, but whose ability to serve their communities is being undermined by excessive regulation and government micromanagement. The real costs of the increased regulatory burden are being felt by small-town borrowers and businesses that no longer have access to credit. When a small town loses its only bank, it loses its lifeblood. It's more difficult to improve schools, health care facilities, and other infrastructure projects. I know it was not the intent of Congress when it passed Dodd-Frank to harm community banks, but that is the awful reality. One issue in particular that has hindered the ability of community banks to serve their communities are the new qualified mortgage rules. As a result of the qualified mortgage rules, our bank no longer makes mortgage loans, as the costs and the risks are just too high. Make no mistake, the true cost is felt by my community. I used to make mortgage loans that averaged $50,000, and I made them to borrowers who would not otherwise qualify for secondary market loans. I'm not the only bank in South Texas to exit the mortgage business. Other banks in my county have stopped, as well as community banks in adjacent counties. This is occurring in Texas and across the country. The real victims here are the working class and middle class prospective homeowners. Banks want to make safe, profitable mortgage loans. Denying mortgage loans to borrowers otherwise considered creditworthy goes against every sound business instinct a banker has. Accordingly, we support H.R. 2673 and H.R. 4521. These bills would exempt any mortgage held on a bank's balance sheet from the ability to repay requirements and exempt loans held by small creditors with less than $10 billion in assets from the escrow requirements imposed by the Dodd-Frank Act. No bank is going to hold a loan it doesn't believe the borrower has the ability to repay. In conclusion, I ask this committee to look at the unintended consequences of the Dodd-Frank Act and to make changes so that community banks can go back to what they've always been good at, meeting the credit needs of local individuals and small businesses. Unless major changes are made, compliance costs will continue to drive massive consolidation within our industry and limit the ability of our nation's community banks to drive Main Street growth across the country. Thank you very much.
Mr. Carfang, you are now recognized for your testimony.
Good morning, Chairman Henseling, Ranking Member Waters. I'm pleased to be here today.
Again, if you could pull the microphone.
Yeah, well, Mr. Wilson, you want to respond to that?
I just wanted to plead with former Chairman Frank to support community banks as in House Rule 2673, not to say you won't support that because of something that was said here, but to support community banks as in the exemption from those mortgages we hold in our portfolio and from the escrow requirements, to support that concept.
I will certainly work for that end. I would simply say I can't negotiate with someone who says I'm a liar.
I do have one quick question I want to ask before I lose my time. You know, one of the things that has happened,
options, and they lend based upon personal relationships and local knowledge of a community, not just statistical equations. Unfortunately, Dodd-Frank too often forces these vital institutions into regulatory straitjackets that are designed for big banks, causing them to reduce lending, merge with competitors, or shut down. My constituents in the 14th District of Illinois demand answers to this problem, which is why I'm really grateful for this panel here today. With that in mind, I want to address my first question to Mr. Wilson and ask about how Dodd-Frank is impacting your community bank's bottom line. I've heard from many financial institutions about how high costs imposed by a growing mountain of additional rules, regulations, and compliance burdens are being faced by the industry. Are you concerned that these regulations could force your bank to limit its offering of certain financial products to consumers generally and low-income consumers specifically? And what about the impact that these regulations, as well as their subsequent enforcement, have on the availability and affordability of credit for small businesses and consumers?
Congressman, our market is low to moderate income people. The community we serve is 65% Hispanic. The withdrawal of us offering home mortgages is not good. There are products that we have looked at and chosen that not to offer at this time till we figure out the risk. We're a little behind the curve on some of the new technologies. So that's the impact of the risks that we try to face each day.
If I have time, I want to get back to a few more questions with you, but I do want to just remind this committee where this all started from. I want to go back.
In order to avoid these regulatory burdens, do you believe that Chairman Frank lived up to his end of the bargain in terms of exempting small community banks from the regulatory burdens?
Oh, we are subject to those regulations. We are not subject to examination by another agency, but when they make changes to the regulations, it changes my whole processes, and it changes my training of my staff, and so it is very complex.
Time of the gentleman has expired.
Are not monitored, who are not regulated, are going to show up and fill that vacuum. Is that the way you would read it?
Unfortunately.
And you said that you don't give mortgage loans anymore just because of the high risk. What risk do you find involved in giving mortgage loans?
Well, there's the compliance risk, and it's the being told what kind of mortgages I can make, and then going through and trying to do the qualified mortgage.
Yeah, that whole list of things, the full two sheets.
Having to escrow taxes and insurance. We're just not staffed or equipped for that type. never have in my 35 years.
And so again, we're going to make it harder for people in rural areas, especially on the lower income spectrum, to get loans for houses or Traeger houses. Do you ever find any competition coming in from Wall Street to loan money for houses in your district?
No, sir.
Yeah, so basically what we're telling rural America with Dodd-Frank is that if you live in the rural part of the country, you're just going to be up the creek without a paddle. Or there are other descriptions we could use, but we'll probably leave it to that one. Mr. Chairman, I would yield back the balance of my time.
Of these two regulatory behemoths have created a greater burden on your institution, and has it, if so, has it been to the benefit of your employees or your customers?
Well, no, sir. We've always provided health care to our employees. The benefit of the Health Care Act is, since we're small, we provide insurance, we get a tax credit.
Right.
This year I'm struggling because the IRS is telling me one thing, my accountant is telling me another thing about buying on the exchanges, and so spent considerable time with that issue. In the financial institution regulations, yes, there's a lot of time and effort. It's not only complying with what is passed, but just think of 14,000 pages.
Do you think the recovery could be better without that regulatory burden?
It would free me up to do other things.
And make capital available to those who you think would be qualified to use it to encourage an even stronger and thriving economy?
Yes, sir.
I yield back.